Karin, why don't we pick up with where Steve left off? Are you concerned about the Fed over-tightening, particularly given what looks like a very sort of sweet employment report and cluster of economic conditions?
You know, there's no doubt that this was a good report overall. It corresponded to a lot of the data that we see here at LinkedIn. But to answer your question, absolutely, there's been 500 plus basis points of tightening, and that's a lot to digest for the economy. So like many economists, we're expecting, that soft patch to hit much later this year or even earlier next year. So I think the risks are still there for the Fed as to whether or not they've done too much. But in the meantime, the labor market is very resilient, very strong from the way we look at it. And we're seeing, even a glimmer of hope in some sectors.
So, Ron, where do you come down on this idea of a possible recession, or maybe that a recession doesn't occur until next year, if at all? And what are the implications then for stocks?
So remember exactly a month ago on the last unemployment report, we talked about Goldilocks, the fact that the economy was still growing, that jobs were being added at a reasonable pace, and wage inflation was coming down. Wage inflation is growing most at the bottom 10th percentile. So we see wage earners right where you want it. It's growing faster than prices are. So that's also something that you want. This seems like a reasonable environment. There are risks. I mean, next year, I should say, $1.4 trillion of commercial real estate debt will come due that will have to be refinanced at higher rates. That could be problematic for certain banks, $270 billion of which is small and medium-sized banks, that they have that on their balance sheet. So I think that's where the risks may come in. The Fed overdoing it, obviously, as I suspect that was David Kelly at J.P. Morgan who was making that forecast that Steve referenced, pushing off the recession into next year. That seems like a reasonable bet at this point, given that unless the Fed were to do something more than a quarter point and shock the system, we're kind of, moving along nicely.
Karin, can you give us some granularity on where strongest and weakest parts of the labor market? I mean, what are some of the indicators you guys look at or might have proprietary access to?
Yeah, absolutely. So we spent a lot of time thinking about the rebalancing of the labor market. That's been a really important question because the more it's out of whack, the more likely you're going to get wage pressures. And what we're seeing is that the amount of jobs coming down in the sense of that there are not as many open jobs available, that's come down by over 20% in the last year. At the same time, we're seeing job seekers much more active. They're applying to more jobs when they show up. So there's like a 30% increase in the intensity of job seeking. So that's kind of creating a more competitive labor market, which means we're going to get some downward probably pressure on wages to continue, which is a good thing, I think, for the Fed. At the same time, we're also looking at just general labor market tightness and hiring trends. And the hiring trends are telling us that overall hiring is still coming down. People are still hiring at a slower pace than before, but there are pockets of hope. Believe it or not, the real estate sector, the construction sector, healthcare and hospitals, all these sectors are actually doing a little bit better than they were a few months ago. So there's some stabilization and maybe even hope of improvement, further down the line.